Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Bernard Reisz. Thanks for being on the show again, Bernard.
Whitney, thanks for having me on. I enjoyed doing the first show. I'm glad to be back here, and it's amazing how far we've come. This has become a top daily real estate podcast. It's just awesome to see what you're doing, and I'm looking forward to today's episode.
Awesome. I appreciate that a lot, Bernard, and I just appreciate your expertise. It's definitely a subject where, I rely on people like you to give guidance, because there's no way we could know all these things. I'm not going to know it, and so I'm going to trust somebody like yourself. But Bernard is a CPA. He empowers individuals to optimize their finances using proactive and innovative strategies. He provides an integrated approach to tax and financial planning for real estate pros, focusing on their unique profiles and opportunities. I like that, focusing on their unique profiles, because everybody's different, right? But he's the founder of 401kcheckbook.com, which gives investors direct control of their tax-sheltered funds for real estate, equity, and debt opportunities using checkbook control IRAs, solo 401ks, and checkbook life insurance. He is also the founder of agentfinancial.com, which provides tax and financial services to real estate professionals, including real estate agents and mortgage brokers. And prior to funding Reisz, Bernard served as director of Co-Metrics Partners, managing an array of engagements involving financial consulting and due diligence. Bernard advises owners of closely held middle market companies on advanced tax mitigation strategies. Bernard, my goodness, you're just you've done all kinds of stuff. You're an expert, and it sounds like finance, and you're a CPA. Obviously, you know the numbers backwards and forwards, which is a fantastic skill, to either to have or to know somebody that has those skills, right, in this business. But thanks again for being on the show, and I look forward to our topic today. And just so the listeners know, Bernard and I are going to do a couple shows or a few shows about some different topics, and just to clarify some things, in his line of work that in the syndication business we all need to be familiar with. And so, Bernard, get us started, and what we're going to talk about today, and let's dive in.
Let's do this. Just by way of introduction, what we're going to focus on is QRPs and IRAs for investing in real estate, be it equity or debt. So it's a really high level. It's about using IRAs, 401ks, and other tax-sheltered accounts for investment assets that are off Wall Street, that present higher risk-adjusted returns, and many of us want to get into. So there are lots of ways to do this. There are lots of subtopics. We'll try to keep it organized and in a manner that's easily digestible. I think the first episode will focus on the QRP / 401k. We'll do an episode about IRAs, and that's, again, there are lots of different IRAs, and subsequent episode perhaps to bring it all together, wrap it up, and describe what kind of services people can expect. How does that sound? Sounds great.
I was telling Bernard, we haven't had anyone really talk about QRPs, in depth and what that is. And, I've heard that mentioned at different conferences and things like that. But, most people are like, what in the world is a QRP? I have no idea. Or other people think they need it, but they really don't know for sure, I think. So, that's why we got Bernard.
We're going to try to shed some light on this. And it's good, even though, anybody that's listening to this episode should definitely go back and listen to our prior episode where we spoke about using checkbook IRAs, checkbook 401ks, kind of as foundational information. But just at a very high level, it's important to know that what we're focused on is taking those IRAs and 401ks that you may be used to using for mutual funds and the stock market, and putting those into real estate-based investments. Without getting into too much detail, that is certainly legal. Tax code is not there to tell you how to invest. Tax code is there to incentivize you to invest in a way that will give you the highest return over time and give you the biggest nest egg. And we're here to use those tax advantages for the asset choices that you choose and control.
It's awesome. It's awesome. Let's dive into the QRP 401k, Bernard.
Let's do it. So QRP is just a brilliant abbreviation for Qualified Retirement Plan. There are different types of tax sheltered accounts that are created by the tax code. So IRAs, be they traditional IRAs or Roth IRAs, are governed by Section 408 and 408A of the tax code. And those are IRAs, and IRA stands for Individual Retirement Arrangement. Those are accounts for individuals, individual accounts. And even if you've got a SEP IRA, again, it's always coming back to individual retirement arrangement, even if there's some sort of business involved in creating the account. The QRP, or Qualified Retirement Plans, refer to a completely separate group of tax-sheltered retirement accounts. Most of them are governed by Section 401 of the tax code. And that's why we've got this really creatively named 401k plan. It just takes its 401, Section 401, paragraph K, subsection K of the tax code that talks about 401k plans. The technical term is a CODA, a cash or deferred arrangement. So qualified retirement plans for Section 401, IRAs, Section 408. Now, qualified retirement plans do have many advantages over IRAs, but they are generally far more complex than IRAs. So they've got benefits, they've got increased investment strategy, they've got enhanced tax strategy, but they've got a whole lot more compliance work out there. But QRPs encompass defined benefit plans, defined contribution plans, profit sharing plans, cash balance plan. From a purely technical perspective, there's a whole array of plan structures and plan designs that fall under that rubric. But within the real estate investment space, while you can use all these plan structures for real estate, and you can use it even technically, if you've got a company with thousands of employees, in practice, when we talk about using a QRP for real estate, and anybody that talks about using a QRP for real estate is talking about a solo 401k plan. Now, solo 401k is not anywhere in the tax code. You can read Section 401, the tax code, the regulations, the case law. There will never be a mention of solo 401k. It's not a technical tax term. It's there more to explain who this plan is made for and how we can give you a QRP that can give you this incredible flexibility at this incredibly low cost.
So QRP and 401k, essentially the same thing?
In practice, they're technically not QRP from, as I said, a technical perspective. QRP encompasses many, many plans. But within the real estate investment space, when we say QRP, we're talking about an owner-only solo 401k.
Okay.
And the reason for that is within the labor code and regulations, and that's Section 29 of the U.S. code, right? So the Internal Revenue Code or the tax code, that's Chapter 26. Labor law, ERISA, that's in Chapter 29, if we really want to get technical. So exempts solo 401k plans from almost all the burdens of ERISA. ERISA is the Employee Retirement and Safety Act. And those are that's the law that makes retirement plans expensive to manage and complex to manage. And those laws are there to protect employees. So you can imagine you've got a company, you've got employees. Congress says, hey, we're giving you this tax sheltered account because we want your employees to have the benefit of saving for their retirement in a tax advantaged way. Well, Congress is concerned that the owners of the business or the highly compensated employees, the C-suite, the big shots, they're going to take advantage of the plan and kind of keep all the good stuff for themselves and not give any of these tax benefits to the employees. To prevent that, There are all sorts of regulations in place requiring annual testing, ACP testing, ADP testing, to make sure that everybody's deriving the same benefit from the plan. So it's twofold. First, you've got to actually run the plan in a way that meets all these compliance requirements. Secondly, you got to prove it. So you have to have administrative work. You've got to test. If the plan, if it turns out you fail the annual test, then you've got to adjust. It gets to be messy, cumbersome, and expensive to run a full-blown 401k plan, especially if you're going to allow investment in real estate and alternatives. It gets to be very costly. So what we focus on is a business that has no employees other than the business owners and their spouses. So when there are no employees that are not owners or their spouses, Congress says we don't have to apply all these rules because you guys are the owners and the employees. You're one and the same, or you're a spouse, so we're kind of going to treat you the same as the owner. You don't have to follow all this annual testing. You can kind of do whatever you want because we're not concerned that somebody's taking unfair advantages of the tax code. And that's why we focus on solo 401k, or what we call an owner-only 401k, creating 401k plans where only eligible participants are owners of the business or their spouses. I know that's a lot of information. What kind of questions are coming to mind, Whitney?
Parts of it sound complicated. All the annual testing, there's a whole array of plan structures you talked about, and how do we, if we're just thinking about using our 401k, or now we're trying to figure out if we need this thing called QRP, and I guess help us determine which we need and why.
Yeah. So now that we've kind of identified and narrowed down which QRP is our focus within real estate, and that's the owner-only 401k. So then the question is that the plan for you? When is that the plan for you? Who is that for? And how do you qualify for it? Because we do have the IRAs, which we'll focus on our next episode, as also a way to get into real estate. So do you want a QRP or an IRA? Which one do you need? Which one is better for you? So in general, in terms of the hierarchy of what we want our clients to use, QRP 401k is the preferred plan. However, you've got to qualify for the owner-only QRP. And if you don't qualify for it, it is not the preferred plan. I can't emphasize that enough. It's the preferred plan for those that qualify. It's the highly unpreferred plan if you don't qualify. And for those, and there you get to the next tier, which we'll use a checkbook IRA generally. And your last resort is to take a distribution from your IRA, a taxable plus penalty distribution to get into real estate. So being that the QRP 401k is our preferred structure, what does it take to qualify? A qualified retirement plan has got to be tied to a business, as we say, an owner-only business. So what is a business and what isn't a business for these purposes? A very common misconception, and there are a couple of them actually, is that rental real estate income is a business for purposes of qualifying for a QRP. It is not. And for those that have rental properties, they'll know that a great benefit of rental income is that you pay income tax on it, but no payroll tax. So that kind of shows you that the status, that rental income has a unique status within the tax code. It's exempt from payroll tax, and therefore it's not a business to qualify for sponsoring a 401k. Property management income is great. That's ordinary income. It's a trade or business. It's subject to to payroll tax. And if you've got property management income, you can definitely sponsor a QRP. Go ahead.
So about, I was thinking, if I have 10 single family homes and we have that rental business, that I'm not going to qualify. However, if I claim I have my own management company over here that's managing them, then the income for the management company that's paid by the rental business, now all of a sudden I qualify.
Yes and no. So that concept is a great concept. In practice, you've got to know how to implement it. And this is another area we're seeing a lot of confusion. People are saying, hey, I've got rental properties, so I'll just classify some of that as property management income. And we know certain people seem to be advocating that people do that. That does not work. And the reason for that is very simple. At least without some structuring, it will not work. It definitely can work, but simply taking some of your rental income and reporting it on your tax return as property management income does not change the true nature of that income. You can't arbitrarily recharacterize income from one type to another. And where you put it on your tax return does not determine its inherent nature. The IRS audits that. They'll just say, hey, you tried to trick us because you took some of your rental income that should have been on Schedule E and you put it on Schedule C incorrectly in order to create a QRP. You're a bad guy. You're playing games with us. Once that money gets to your pocket as rental income, you own the property, you got rental income. You can't have a property management agreement with yourself, absent inserting any entities or structuring. So while it is doable, it does require some structuring, and I'd say that's a bit beyond the scope of what we want to cover here, but it is doable. But it's also important for people to realize that there is a downside to this, because what you've done, when you do that, you take your tax-advantaged rental income, because there's no payroll tax on your rental income. But when you move that to your Schedule C, or however we would structure it to create property management income, you're going to be paying an additional 15.5% tax on that, because now that is subject to payroll tax. Is that something you want to do? Is it worthwhile? In many cases it is, but it's important to note that the analysis is more nuanced than others would lead you to believe. So moving something off your Schedule E is something you may not want to do. It may be a great move. It may not. It needs careful analysis.
Who is Vinny Smile Chopra? Came to the U.S. from India with $7 in his pocket, and today he has created a portfolio of over $200 million in commercial real estate. He's a CEO of 5 companies, acquiring and managing diverse multifamily portfolio of 3,500 units, and his team self-manage all the assets. Vinny has walked the walk with over 26 successful syndications during multiple economic cycles, including downturns over 12 years. He has built a very extensive educational academy to teach and mentor investors. Vinny, tell us about this Multifamily Syndication Academy.
Thank you, Whitney. Thank you so much. I'm really proud to really talk to everybody about this extensive multifamily academy that teaches new and sophisticated investors how to use other people's money through syndications. That has been my world, to buy apartments from 50 units to 500 units, and how to select emerging markets, how to do deal analyzing, investor education, other people money, syndication blueprints. Everything I have learned, I teach in this academy, and over 500 lectures, and also how to manage the assets also, and along with lots of great templates and PowerPoints, everything. And I personally also mastermind coach all my students every Wednesday. So to reach me, Whitney, all the students have to, or investors have to, just text the word LEARN, 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 to 474747, or call my team at 925-766-3518.
Wow. A lot to think about, but, and I guess, thinking about, QRP, I'd like to know like who your most common or the best client, just in layman's terms, for, QRP versus, not using QRP. I just think it's like this brand new, it seems like this brand new thing that people are talking about, but who's that commonly going to be used for the most?
It's for people that have some sort of their own business. So real estate agents, that's great. They know real estate, they understand it, appreciate it, and they're all independent contractors. But with the gig economy that has emerged today, so many more people can qualify. Because if you're doing driving, ride sharing, if you've become a consultant, anybody that's got their own business qualifies. And it's okay to be working for somebody else, because a lot of these are side gigs. A side gig, in most cases, is also a business. If it's something that you're really doing only, infrequently, it gets to be very questionable. But if you've got something that you're running as a business, but it's part-time, the QRP is for you. But to address some of the other misconceptions and some of the things we've got to contend with all the time, as people say that, I was told that I can just sell I can sell a bracelet on Etsy and I've got a business. A part-time business is a business, but it's got to be a business. The IRS says it's got to be something that you're engaged in on an ongoing, continuous basis to generate a profit. So a one-off is not a business. And there definitely are various shades of gray of what is or isn't a business, and we can't give you conclusive answers about that. But we can say that when you're kind of at one extreme, you sell one bracelet on Etsy, that's not a business. If you've set up an LLC, that's not a business. You've got to be doing business. And the flip side of that is, if you're doing business, you don't need an LLC. The IRS wants to know, are you engaged in a trade or business to generate a profit? They don't care whether or not you've got an LLC for that. I mean, it's perhaps you should have an LLC. There are many reasons to have, great reasons to have LLCs for your business, but in general, sponsoring a QRP 401k is not one of them.
And I think too, like, if you could just, in layman's terms again, just lay out, why would I pursue a QRP? Just a couple of benefits, like
okay.
why would I do this? All
right. So a QRP has two components: the tax component, the investment component. Let's talk a bit about the tax component. With the QRP, you can get upwards of $56,000 per year in tax advantage money, be it tax deductions or Roth money. That's super, super powerful. And you don't need a custodian, so you can directly put the money into any deal that you want without any custodian involvement. So it can be really cost effective and simple. In terms of the investments, of course, you can get into just about any type of deal and asset that you'd like. Within the tax advantage space, there's a tax known as unrelated business income tax. And one of the ways you can fall into that tax is by something called UDFI, unrelated debt financed income. So even in the tax-free world, there are certain cases where things are not tax-free. Now, this tax is definitely not something that should deter anybody from using tax-sheltered accounts. In most scenarios, it's absolutely not a deterrent, but completely tax-free, totally tax-free, certainly beats even having to deal with a little bit of tax. And for QRPs, there is a carve-out, and that exempts them from UDFI within the real estate investment space. And to touch a bit on UDFI in this segment, we'll elaborate more on the IRA segment where you're more likely to encounter it. One of the great benefits of real estate is that you can leverage it. You come in with 25% of the equity, you can get a property, you can leverage up and get another 75% from a lender, from a bank, from a financial institution, because they're secured by this hard asset. Well, unrelated debt financed income, that could be taxable within an IRA, you'll hit that when you use leverage. So to keep it super simple, assume that, say your debt, that ratio is 75-25. Within an IRA, there is potential for tax on the portion of the deal that was financed with debt. In a QRP 401k, that does not apply. And that's just an incredible benefit, not so much because the tax liability in an IRA will be great, because it really isn't. But it's great not even to have to think about it. It's just a nuisance to have to think about tax. Even if the tax bill itself is zero, because in real estate, you're going to have just all your regular real estate deductions are there. So you show on a paper loss, there's no UDFI. UDFI, you get $1,000 of freebie. On the sale where you may encounter it, it's anyway capital gains rates. And overall, you only have the tax on the portion of the money that you borrow, right? So your principal, your equity remains tax-free. The money that you put into the deal is always tax-free. Okay, you got to pay some tax on the leverage. Well, you're paying some, that's on the OPM. All right, it's a little cost to having the OPM. Try to invest in stock. Go to Fidelity and say, hey, listen, I've got $100,000 in my IRA. I'd like to buy $400,000 of mutual funds. Can I have a loan? That's not happening. So it's still really powerful to put it into real estate and get 75% OPM. Of course, QRP 401k, which doesn't have that, that's far better. So one of the biggest benefit perhaps of the QRP is that you have no UDFI. So whoever we can use a QRP for, we will. That's the first place we want to put people, but not always do they qualify.
So where do we start as far as when I'm thinking, okay, maybe this is something I need to consider this, or, this is really, wait a minute, piqued my interest that this is something I need to learn more about, or, am I going to contact somebody like you and where at in the process, if I'm looking at a deal to invest in, what's the time frame? How long does that take? How much time should I allow?
Yeah, a good question. And we work really quickly, but you've got to respect the fact that you're working with regular financial institutions and it takes them time to move money around and to be, review paperwork and process it. So the great benefit that we offer is that once you get the money, financial institutions are out of the picture and you never have to wait for them again. But during the initial setup, when we're getting the money from your regular custodian into your hands, we got to allow time for them to get the paperwork processed. So we want people to allow approximately 3 weeks of lead time. We may get it done in 5 days, and it may take 5 weeks, depending who's your counterparty, which financial institution is it. So you don't want to show up, say, hey, I've got a deal closing tomorrow. That just also results in a kind of high pressure situation for everybody involved in the transaction. So allow a lead time of 3 weeks before you get into it.
Awesome. So, before we have to go, we're about out of time, Bernard, for this segment. But anything else about QRP, 401k that you want to lay out that we need to know or have at least some understanding about?
Yeah, I appreciate that. So try to make this a kind of a complete self-contained segment. There is an enhancement that we've always offered within our 401ks, which is to create an LLC within the 401k. It's not something that we have heavily promoted. It's purely optional, but we see some confusion around that 401k LLC versus checkbook 401k. So what is that? So when we talk about the checkbook 401k, checkbook QRP, all different marketing terms really to try to convey to people what this is, because we just say section 401k, they're not going to understand who it's for and what it does. We're talking about a qualified plan. A qualified plan does not need to have any LLC inside it in order for you to get direct control and to have all the tax benefits and much of the asset protection benefits afforded by labor law. However, we do, as an optional feature, we'll put an LLC into the 401k. It provides enhanced asset protection, which is beyond the scope of this discussion, but is an enhancement. And it also provides for more streamlined investing. So when you invest with a checkbook 401k, you'll be going to the deal, to the closing, and you'll be doing the name of the deal and the name of the 401k. Well, not everybody's familiar with that, and that can kind of throw people off. Or maybe you don't want people to know exactly that you're using your 401k for the deal. So by putting an LLC into the 401k, so the 401k owns the LLC, and then the LLC does the deal. Well, you come to the table with an LLC, and that looks just like business as usual. So it provides asset protection benefits from the couple different aspects of that. Maybe we can talk about that more in the IRA space, where we use LLCs in just about every structure, and provides more streamlined investing. So there's a distinction between, we say checkbook 401k, and then we say 401k LLC. The 401k LLC kind of sits underneath the checkbook 401k QRP.
Awesome. Bernard, you're an expert in this space. I'm thankful to know you and appreciate you sharing on the show today. And unfortunately, we're out of time for this segment, but we're going to have you back, obviously very soon, and we're going to follow up on some other topics that is very important. Bernard, tell the listeners how they can learn more about you and get in touch with you so they can just really dive into their unique, situations.
Yeah. Firstly, Whitney, got to say thank you so much for having me. I appreciate the opportunity to share knowledge with your audience. And the best place to find me, my company, is at 401kcheckbook.com. That's 401kcheckbook.com. No hyphens, no spaces. And at agentfinancial.com. We've got lots of information, particularly at 401kcheckbook.com. Webinars, podcasts, blog posts. We encourage everybody to get educated, get informed. And if this is something that interests you, we'd love to assist.
Great. Bernard, thanks again. I hope everyone will reach out to Bernard when you have these questions, when you're ready to invest with your 401k or QRP or figuring that out, what works best for you and your situation. Also go to Life Bridge Capital and connect with me. I'd be happy to get on a call with you when you sign up on the website, and also go to the Real Estate Syndication Show Facebook group, and so you can connect with other experts and people like Bernard, and we can all grow our business together. And we will talk to each of you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.